US CPI holds firm in October, but is reflation on the horizon. Welcome to Market Insights. I'm Peter Devlin. US consumer prices increased as expected in October, climbing 0.2% for a fourth straight month. Figures underscore the slow battle against inflation, with traders now grappling with a new set of policies under President-elect Donald Trump. With companies already considering raising prices in anticipation of higher tariffs, how will the Federal Reserve and Wall Street face reflation risks? Well, joining me now to talk about all that is David Sekera, Chief Market Strategist at Morningstar. Welcome, David. Thank you very much for joining us. So let's start with the CPI print today. And core inflation reading rose 2.6% from a year earlier. That marked the first acceleration on an annual basis since March. So what is jumping out for you in this report?
Well, overall, the number did come in a little higher than we expected, but I know our U.S. economics team is not necessarily overly concerned at this point. Specifically, they pointed out housing and used auto prices, coming in higher than their forecast. But we still think that housing inflation is due for a correction and probably comes through in the next couple of months. And also, he just noted that these are areas that have a lower weighting in the PCE, the personal consumption expenditures, which of course is really the Fed's main gauge for inflation. So right now we expect core PCE later this month to come out at 0.2% a month-over-month basis, and that's only slightly higher than a rate consistent with a 2% annual rate of inflation. So pretty close to the Fed's long-term target.
Keeping with the Fed there, and traders did mark up the odds of a December interest rate cut from the US Central Bank to around 70% after the print. So is there anything now that could derail a Christmas cut?
Yeah, well, it's possible, but certainly not probable in our view. We're very comfortable with our continued view that inflation will continue to moderate in the months ahead. We will keep a pretty close eye on the labor market, specifically payrolls when they come out. We just want to make sure that it doesn't get to be too hot, such that the Fed might be concerned about wage growth accelerating too fast and could lead to a rebound of inflation. And depending on what happens in the labor markets over the next couple of months, maybe that leads to the Fed pausing or skipping a couple of Fed rate cuts over a few meetings. And of course, it's also going to depend next year on what the Trump administration may or may not do, depending on what, if any, tariffs they put in place.
So you did mention Donald Trump there, and Wall Street has surged after his decisive election victory. So are we at risk of stocks overheating, or is Wall Street's rally got legs to run further?
Well, I think we're already getting to the point, according to our valuations, where we are starting to get a little bit overheated. As you noted, we had the Trump bump or the Trump rally, whatever you want to call it. But in my view, I think it's probably run its race. I think that at this point, a lot of investors probably need to start really understanding the valuations, in the market when we start looking at our long-term valuations. The U.S. stock market right now, in my view, really is priced to perfection. And I think there's probably going to be limited upside until earnings start to catch up with valuations. So, for example, the U.S. market overall is trading at about a 6% premium to a composite of our fair values. Now, 6% may not necessarily sound like much, but if you look all the way back through 2010, less than 10% of the time has the market traded at that much of a premium or more. So I think positioning is even more important now than it has been, really over the past, decade or so. So in our view, small caps still remain one of the most undervalued parts of the market. So we'd overweight small caps. They traded at 9% discount to fair value. And we'd still also overweight the value stocks. Now, they're pretty close to fair value overall, but relative to where growth stocks are trading, growth stocks being at a 24% premium to our fair value, value looks like a much better bet in our view.
So finally, David, and investors have poured money into reflationary trades in anticipation of Trump tariffs. What sectors are you looking at?
It's really the ones that we consider to be the most interest rate sensitive. So to the upside, we actually see a lot of value in the energy sector. It trades at about a 5% discount to fair value. And what I really like about that is we actually have a relatively bearish long-term outlook on the prices of oil, coming down to $55 a barrel for West Texas and $60 for Brent over the long term. So I'd point to companies like Devon. That's a 4-star rated stock, trades at a 20% discount. We also like the basic materials sector, specifically the chemicals industry. One of our recent picks there from our analytical team was Dow. That's a 5-star rated stock, trades at a 35% discount, and provides a pretty good dividend yield at 6.2%. But to the downside, I'd be very concerned about the utility sector that trades at a 13% premium to fair value. In our mind, the AI growth story there has already played out. And if interest rates rise further from here, I'd say look out below in that sector. And of course, real estate. Real estate overall pretty fairly valued, but higher interest rates certainly would be a headwind there. Personally, I'd still steer clear of the office space, but I'd stick with a lot of the more defensive-oriented real estate plays, those in healthcare or medical offices. Our pick there is Health Peak. It's a 4-star rated stock, trades at a 30% discount, and has a 5.5% dividend yield.
David Sekera of Morningstar, thank you very much for your thoughts. And that's Market Insights. Don't forget, you can watch more videos on Reuters.com.